Hi, I'm Sharon Winsmith, a tax attorney, active investor, and your go-to resource for proven investment and tax planning strategies. In this video, I'm going to share some frequently asked questions that I get about index fund investing. If you've watched my other videos and understand that I'm a big fan of only investing in S&P 500 index funds when it comes to the stock market, then you know that that is really my preferred approach, and I don't do stock picking. I also don't invest in things like mutual funds because I think that they're a disaster. So in connection with that and the materials that I put out on that, I get a lot of questions, and I get a lot of the same questions about my approach of index fund investing. So I thought I would just record a quick video and run through some of those common questions that I get really quickly. So again, this is just not investment advice. It's just my personal opinion on, my approach of index fund investing and how I approach this with respect to my own personal investments. So the most common question I get is, should I invest in international stocks or funds? So what about getting, exposure outside the US? I think this is a very smart question to be asking, but I personally don't allocate anything to, any specific international stocks or funds. I think that when you start doing that, then you're starting to kind of get back into stock picking, because which funds do you invest in? Which international stocks would you buy? I'm not a fan of buying individual stocks. I'm not a fan of trying to decide what companies are going to, perform well and what aren't. And historically, while yes, I do believe at some point international stocks may even outperform, US shares in the future, or funds may be very successful, I don't do it now. Historically, the returns haven't really been great with a lot of the different ways that you can do this and some of the more popular approaches to investing in international. There are some international indexes, but again, like the historical performance just hasn't been as kind of promising and consistent, I think, as the S&P 500. So it's not to say I wouldn't change my mind on this in the future, but right now I'm not spending any time allocating money to international funds or index funds in that respect. What other index funds than the S&P 500 do I invest in? I don't really invest in any. So I used to do the total stock market index fund, which I'll talk to you about in the next one, which kind of go hand in hand, but I really do S&P 500. I do the Vanguard S&P 500, ticker VOO, because it's, the lowest expense ratio out there that I'm aware of. So it may seem crazy to have millions of dollars in one ticker, but you really have millions of dollars in, the S&P 500. So you have to think about it that way. And, it's just a strategy. I like to keep it simple. I like to use common sense investing. Warren Buffett, I think, issued a shareholder letter where he explained in the past how he had instructed his estate to be, invested if something were to happen to him. And I think he said 90% into an S&P 500 index fund. So if he can put 90% of his money into an S&P 500 index fund, I'm certainly happy putting, a couple million in there myself. So no, I don't invest in other index funds in S&P 500. What about the total stock market index fund? So this is a very, very common question. A lot of people advise that you need to, invest in the total stock market. What this would be, and VTI is, the Vanguard total stock market index fund. If you were to do that, it's a very low cost approach for doing that. Here's why I don't do that. So the total stock market is every single public company out there. There are a lot of, pardon my language, crap companies that have gone public. The past few years, everybody and their mama was taking a company public. It really, there's not a lot of quality control necessarily there. There are some companies that, I've even considered doing hostile takeovers of public companies that are smaller, where, the market cap and the size is only a couple million, where, you could really, if there were the liquidity available to buy enough shares, which there isn't going to be, but, you could really just go out there and buy that if you've got enough money. So I don't want to own, any piece of those small companies. Yes, there are small cap companies that are going to do great and going to explode in value and will at some point, come into the S&P 500. At that point, I'll own them. But there's just, in my opinion, too much crap out there. I don't want small mid-cap companies. I'm happy investing in the largest 500 companies. Again, it's a simple approach for me, and I'm not going to, I know a large portion of the total stock market fund would not be allocated to those smaller companies, because if it's weighted on size. But again, I don't want to own the whole stock market. I want to own the tried and true 500 largest companies that are performing the best. That's just my own personal opinion about that. All right, so what about investing in these high dividend paying companies for cash flow? So there's this thought out there, and a lot of people hold this thought. A lot of financial advisors hold this thought. And it's, this idea is that you want to cash flow invest in the stock market. I think a lot of people like cash flow investing. Robert Kiyosaki, who wrote Rich Dad, Poor Dad, talks a lot about cash flow investing. I don't think he's necessarily talking about high paid dividend shares. When he talks about that, I think he's really talking about real estate, where you get monthly rental income from whoever's renting your property. But the idea is that I want, money off the table from these companies paying high dividends like Coca-Cola, just companies that have had a steady history, a stable history of paying high dividend yields compared to other companies. So here's why I don't like this strategy and I don't think it makes sense. Number one is that when you're getting dividends from a company, you're taxed on that. So yes, the S&P 500 index funds are going to have a dividend yield, but it's much smaller, but you're getting taxed on dividend income. So yes, it's usually ordinary dividends that, qualified dividends that are taxed at a lower rate, but I don't want to pay capital gains tax rates. People for some reason think that that's a great rate of tax to pay. It's not. A great rate of tax to pay is zero tax. So I don't want to pay tax on dividends. I always use drip elections when it comes to stuff like this. So if you're not reinvesting those dividends immediately back into the company by having a drip election or taking that money and immediately putting it into another investment that's getting the same returns, you are not getting as good of returns as you could. So if I make an investment, I'm happy to have that drip election. I'm happy to reinvest. I don't need to take cash out to take risk off the table. I've never really understood that. No, you don't want things to get to the point where you've got too much of your money allocated to, one thing because of a drip election. But I want to keep 100% of my money invested at all times. I don't ever want to have cash drag. You're going to have that if dividends are coming out, off the table if you're not putting them back into the company. So if you're just putting that money back into the company, you're paying tax on it. Whereas companies that do not pay dividends are taking that same money that they could have paid out to shareholders and they're reinvesting it into the growth of the company. So the thought is that, and instead of dividend income coming out to you, you should be getting a corresponding increase in the value of the company. They're reinvesting into the company. Hopefully they're doing a good job of it. And you'll see that growth in the share price over time. You are not paying tax on that growth in the share price until you sell those shares. So I would much rather have tax-free growth indefinitely than have dividend income that I'm just, as I said, a drip election, reinvesting that back in and paying tax on. So I've never thought this strategy makes a lot of sense. I think it makes people feel good. I think it's, again, going back to the psychology of this. You feel good about the fact that you're seeing that money hit your bank account. You're getting cash out of the company. But I don't think really, in my opinion, it makes a lot of sense. Should I invest in stocks or my retirement accounts? This is a very good, smart question to be asking. So if you're doing the index fund investment approach where you're doing buy, borrow, die, you're going to do what I do where you buy VOO, buy that S&P 500 index fund, hold it for the rest of your life, then you do not want that in your retirement account. Yes, there is going to be some leakage of dividend income, but you should be able to offset that with other tax planning strategies. Take my courses if you don't know how to do that. But if you've got it inside a retirement account, it's hard to do buy, borrow, die. It's hard to use SB locks. We love SB locks when it comes to stocks. One reason I probably, if it weren't the ability to borrow against my stock portfolio so easily at such a low interest rate, I would not invest in the stock market. I would invest in much better asset classes that are available to me. But I love the ability to be able to kind of use my stocks as it really is my checking account, as one of my stock accounts. But I can borrow against those shares and invest in something else and, double dip and increase my return. So another reason is that I'm happy to own those VOO shares for the rest of my life. So I don't want those assets in my retirement account. There's better assets you can put in your retirement account that, aren't going to be able to use those into, great tax planning strategies. So I personally don't put them in my retirement account. I think there's better assets and better uses of those accounts. Should I sell when the market goes down? Absolutely not. Never sell. You cannot time markets. You cannot time markets. I don't care how smart you think you are. You're not smarter than Warren Buffett. You're not smarter than Ray Dalio. You're not smarter than, the other people who have been extremely successful and become billionaires from investing and managing people's money. You cannot time markets. So anyone who thinks that is just, I'm sorry, you're going to find out the hard way at some point in your life. And the minute somebody tells me they can time a market, I just immediately stop listening. So don't ever sell when the market goes down. Hold, hodl, as we say with crypto, hold on for dear life. Who cares what the price of your shares are today? Who cares what they are tomorrow? You are not selling those shares. You are not investing for gains in a week, in a month, in a year. You are investing for the long term. I care about what those shares of stock, what the value of my portfolio is when I'm 65, when I'm 70, when I'm 80, when I die. I don't care if the market goes down today and goes up tomorrow because that's irrelevant to me. It's all paper at that point. It's paper net worth, and that's useless to you. Only thing I care about when it comes to where the market is a factor of what I can borrow against those shares. So I never sell. I don't try to time markets. Anyone who tells you they can do that is wrong. I'm sorry. I just feel very strongly about that. I think it's a very bad idea to try to time the market. And when you do sell, let's say you do get it right because you're just lucky, you're not going to get it right in the long term, and you're going to pay a heck of a lot of tax on your gains there. So what about options, puts, calls, other, strategies, derivatives, things like that? I don't mess with any of this stuff. I've never seen, there's never been someone I've met that's really smart, sophisticated, knows what they're doing, who spends any time doing this stuff. There's a lot of, young guys in their 20s and that have YouTube channels with flashy sports cars on there that can teach you how to do this stuff if you're interested. But I don't think it's a good long-term strategy. Just let alone you typically don't do well with this. You can get yourself in a lot of trouble. They like to tout a lot of these strategies like the wheel strategy and, other strategies without having any risk, but they all have risk. If they didn't have risk and if it was this great strategy, then there would be hedge fund after hedge fund already doing this and exploiting this. So I don't mess with this kind of stuff. And, even if you were successful for some period of time with it without getting yourself into trouble, then you're going to pay a lot of tax. A lot of the tax consequences with this stuff is not great. And lastly, your time and the time you spend learning all this, because this gets difficult. This gets, I do know these concepts. I am familiar with these strategies and how they work. But the time you spend on trying to learn this and understand it to the level that you should actually be doing it, I can guarantee you is much better spent on something else, like starting a business or starting a side hustle or, investing in real estate or finding good, quality sponsors to invest in. So I would not waste your time on this, in my personal opinion. If you want to do these strategies, this is not the channel for you. I am not going to cover this kind of, short-sighted, trying to make, gains in the short term. That's just not my philosophy and it's just not my style. So again, these are just some frequently asked questions I get on, index fund investing and my approach to investing in the stock market. Hopefully you found this video helpful. If you did, please like the video and subscribe to our channel.